Getting your business ready for sale is critical. There's some fundamentals that'll help improve your business value as well as help you find the right buyer. Today, we're going to cover getting your business ready for sale. This is one in many videos that we're doing to help people that are new to the business sale process understand things in layman's terms, because we realize it's a bit of a daunting process. So today we're going to cover getting your business ready for sale. There's several things that you can do that will actually increase the value of your business, but also make it more appealing to a buyer. The first thing, though, to understand is that getting the right buyer is critical. 75% of deals fall through statistically between heads of terms and closing, and half don't deliver the value even after they close. And the reason, when you dig in, it's invariably a poor cultural fit. And so it's very, very important that we focus on finding the right buyer and finding the right chemistry. And legacy is very important to people. They may not realize it. They may think they want top dollar for their business or top pound. But when in fact, they care a lot about their people, they care a lot about their customers, they care a lot about their baby actually moving and being to its next stage of its journey and being a better version of itself after the sale. So all of these things are important. But on the way to that, there's several things that we can do to actually increase the value and also lower the perceived risk for a buyer. And what happens is, we cover valuation in another video, but basically, generally we're working with multiples when we come up with the value of a business, and multiples go up and down with risk. Okay, and so if we can lower the risk of the business, then the multiple goes up and the perceived value is higher. If you think about it, most businesses are like a sausage machine, and the sausage is profit. What someone's really doing is buying your future sausage. That's the way to visualize it, not the machine itself in a way. They're buying that future sausage. This is mathematically. So we basically want to make sure that that future sausage is going to come in. So the more risk they associate with that future sausage coming in, because they're going to pay you for that future sausage, and then you're, as the seller, going to be able to go hit the beach. You know, that's the idea of a business sale, is that you get to leave and go do whatever thing that you need to do next with your life's journey. So basically, one of the first things we look at is the quality of earnings, is how confident I am that sausage, if you will, that profit is going to come in. And basically, if you have revenue that's recurring, that's contracted, whatever, there's going to be a lot higher confidence. If you're a contract company, you know, where you have to find the next one every time, well, basically, that confidence is going to go down and the multiple is going to go down. So the thing to learn from that, if you have time to prepare your business, is try and get as much contracted revenue as you can, repeating revenue. Things that you know, customers that repeat order are good. Contracts are very good, although they can have cliffs. And so you want to also avoid that there's all these cliffs and then the customers could leave. A good repeating customer is often the most valuable, but it's that kind of revenue. Maintenance revenue is lovely, where, you know, you have somebody that has something that has to be maintained on an annual basis, and it'd be very difficult for them to go somewhere else. So recurring revenue is very important. Next thing to look at with the value of the business is customer concentration. You don't want one customer with a huge chunk of your revenue, because there's a big risk there. What happens if they go away? Say they're 50% of your revenue, it will crush your business. And so we generally don't like to see one customer having more than 10 or 15% of the revenue, if you can avoid it. So if you have that case today, if you can get it more spread out, you're going to lower the risk. If you have 25% and above, it's a real red light. And that can really dent valuations. And there's ways around that with deal structuring so that both people are sharing the risk, but it's not ideal. And so it would be better if you have time, you know, say you have 2 or 3 or 4 years before you're going to sell your business, is try and diversify your customer base. Another thing to look at is what we call a key person issue. Remember, the sausage machine is going to produce sausage. Well, if I'm going to buy that thing, I need to make sure it's going to run like it's running today. Well, if you, as the owner, are a key person to that, you're someone that we call an X factor leader. You're someone that's been able to navigate this business through its ups and its downs. You're someone that's been able to take the business to where it is today. It's different than management. Management is what's happening day to day. The leadership has been able to navigate the business. If you're leaving, somebody has to be able to come in to replace that X factor leadership energy, and you need to be confident that the business in the sausage machine will keep running. And so the best thing to do if you have time is to extract yourself from the business and have others that come up into that role. We love to hear when we're selling businesses that the owner is playing golf for a month in Hawaii or something like that, because then we know he can leave for a month and the business runs fine. 3 months is even better. But it's the idea that when I buy that thing and the owner's leaving, it's not going to leave this giant void and the machine's not going to work. as I was expecting. Another key thing to worry about is actually vendor concentration. Same thing. If you're completely relying on one vendor and you're a distributor or something like that, and they decide not to supply to you, what's going to happen? Another aspect is capital refresh. If you're a capital intensive company and you haven't refreshed your machinery and things like that, and it's all being pent up, then the new buyer is going to have to absorb that. That creates risk because he's not going to know how much he's going to have to refresh. That's going to drive your multiple down. It also may cause them to do estimates and want to take that off the sale price and things like that. Another big aspect is the actual EBITDA itself. So if you think about it, EBITDA is like a small plane if you have small EBITDA, or if you have a larger EBITDA, it's like a big jet, and both are in turbulence. Which one gets buffeted more, right? So the higher your EBITDA, the lower the risk. I can have one company that's doing 300,000 pounds in EBITDA, and that's a different company that is exactly the same thing doing 3 million pounds in EBITDA, and their multiple will be drastically different. One might be at a 3 multiple, one might be at a 6 multiple. So literally the multiple itself will be doubled because the buyer will perceive less risk because the EBITDA is higher. So that's another thing, is focus on getting the EBITDA as high as possible. That's common sense because the more the EBITDA, the more times the multiple evaluation in the first place, but it has a double whammy in increasing the value. For those of you who don't know what EBITDA is, please listen to our video on business valuation, but it basically is the pre-tax profit that's coming through the business with the, we actually use an adjusted EBITDA figure with any owner benefits, any non-cash items added back into it to give us what the true cash flow that the buyer can expect in year one, if you want to think about it that way. It's sort of proxying what it is currently. How much sausage is this making that I'm going to get the benefit of, on day one buying the business? It's trying to proxy that. But as I said in the business valuation video, this idea of multiples times EBITDA is sort of crude, but it's what everybody uses, so we have to work with it. And so these are the drivers you want to use. Now, when you're actually going to sell the business, it's very important that you explain all of this to a buyer and that they feel comfortable with it, so that you're attracting the right kind of buyer that's going to be a good cultural fit for your business. And one of the big things they're going to look for is good books and records. So they're going to want to, the way that they're going to see into your business, so their heart is going to see into your business by meeting you and meeting the people and getting a vibe of the business. Their head is going to see into the business by looking at your good books and records. And so it's very critical that your books and records in your accounting environment is rock solid. If it's not, if they lose confidence in that, it's a bit like being on a plane and losing confidence in one of the main instruments or something like that. People get very nervous, and if it happens enough, they just leave. Even though they may love your business and all that, they just don't have any confidence. Also, the banks, if there's any lending, won't have any confidence. So it's critical that we have good books and records, and that you get on doing that. And the more information you can give them, the better, on product sales, profitability, things like that. All these increase confidence. What does confidence do? With confidence, I perceive less risk. With less risk, sometimes consciously and sometimes unconsciously willing to give you a higher multiple. And so the more data you're giving me, the more confident I am. Inherently, the value of the business goes up, and the terms are better for the seller. We hope you've enjoyed this video today. If this has been helpful, we wrote a book called Selling Your Business, which has 18 chapters specifically designed for people that are new to the business sale process. There's a free link in the description field below. Please feel free to grab yourself a free copy. We'd also be happy to send you a paper copy. Thank you for listening.